Hey everyone, it's Mrs. B. Welcome to week 3. Pretty exciting. We're just moving along. So, how was your first exam? How you doing? So you got a discussion this week, but you know all that. You can read the instructions. I just wanted to kind of give you an overview of the material this week and highlight my awesome videos. So let's go to. Nope, not that one. How about this one? There we go. So I have all kinds of videos for you this week. This week we are looking at process costing and cost volume profits. So you can check out my 2 process costing. The first one is just a general overview of what process costing is. In my opinion, this is the most complicated thing that you're going to do this term. So if you get through this week, everything else you'll be skating. Okay, maybe not skating, but not nearly as difficult as process costing. In my opinion, is the most difficult concept. So the first video is about just a general lecture, and the second one is actually working a problem. So hopefully that will help you with your homework. And the second one is cost, volume, profit. Probably my most favorite topic in managerial accounting because it is so practical. I'm going to just give you a real life example here shortly, but there's an introduction, there's calculating, some more problems, and then the high-low method. So when you don't know fixed cost and you need to find fixed cost, the high-low method will help you figure that out. So anyway, I hope you find those helpful. So the reason I love CVP is because it has practical applications. So fundraising, my goodness. So it's been years ago. This is back when my children were, which we're all grown now, but my children were in youth group, and the youth minister came. He had $1,500, and he needed $3,000 to be able to send. He wanted to take all the kids to a particular conference, and he needed $3,000. So he decided to double down. I think he probably should have gone to the boat and put everything on red. Okay. Not really, but I think maybe his chances of success would have been higher than what he chose to do. So he had a friend who was in the cleaning supply business, and his friend said, "Hey, trash bags. Everybody needs trash bags. Sell trash bags." And so he's like, "Yeah, great idea." So he took his $15 and bought at $4 a roll 375 rolls. That's 32 cases. Took up the back of the garage at the church. All right, so then he thought, okay, I'm gonna sell them for $8. So that gives me $3,072. So he's a $72 cushion. Woo! All right, but then his math just stopped, right? Because he only had about 15 kids in youth group, maybe 20. So, but let's just say 15. So 375 rolls divided by 15 kids. That means each kid has to sell 25 rolls. Well, it doesn't sound bad, but then you have to think about the some of those kids were multiple families. Probably 6 of those 15 were multiple families. So that means the families had to sell like 50, I think, yeah, 50 rolls, 75 rolls. So that's a lot of rolls. But then it's not these big, huge jumbo trash bags. No, it's these little bitty, tiny office trash bags. And they're like so thin you can see through them. Like literally, the ones you can get at Walmart for $1 or maybe even $3 are thicker than these. So I had to laugh. I don't think it was this year's Fun Fest, but last year's Fun Fest, I laughed because we were still using them. I hear we finally have run out of them, but literally it's been 10 years. So, anyway, needless to say that the youth pastor and the kids did not go to the retreat that year. So, if you've got to make an initial investment of money, of something like, bulbs are another big one. So if you have to buy $500 worth of bulbs, well, if you live in Phoenix, maybe bulbs are maybe not a good choice. So, I don't know. I don't live in Phoenix, so I don't know. Maybe bulbs have a lovely time in Phoenix. I don't know. Just thinking maybe the soil wouldn't be so happy. But if you have to make an initial investment, what do you have to do to get that money back? So, so I use the example of Mrs. B's Famous Apple Cakes a lot. In fact, that's what I use in my examples. But so if you have to put thousands of dollars in your startup, what does that look like to actually get things coming back, right? So, how many cakes do you have to sell before you get dollars in the door? So here's a very brief CVP. Um, so in our initial week, we talked about, so basically we're splitting costs and we're looking at cost, how costs behave. And so we slice and dice differently. So we had product and period costs in our first week, right? So we had product costs, which were direct materials, direct labor, and overhead, right? And overhead had indirect materials, indirect labor, and any other costs, right? So that's last week. This is this week, and we are about fixed and variable costs. So actually, I want to do variable costs first. So variable costs tend to be product costs, but they're not always product costs. So basically you do not incur variable costs until you actually make a product, right? And then it sits in the inventory on the balance sheet till you sell it, and then it gets transferred to cost of goods sold, right? So we learned that in week 1, reinforcing that here in week 2, 3. So so variable costs change with volume, but per unit they stay the same. So let's assume Mrs. B's Famous Apple Cakes that it cost me $10 to make a cake, right? So and I sell them for 25, right? So my variable cost is $10 per unit. So in that $10, most of it's probably flour, sugar, apple oil, eggs, and such, but I might have some variable administrative costs like shipping if I ship my cakes, or I might have variable selling costs like maybe I'm charging the cake box to the selling department. So those generally are period costs. So you could have some period costs that are variable, that they don't incur costs until you make a product. Okay, so that's variable cost. So individually, variable costs don't change. It's always $10, right? But the more cakes I sell, so now if I sell 2 cakes, that's $20. 3 cakes, that's $30. Okay, you can do the math and so on and so forth. So the more cakes you sell, the variable costs increase in total. And then you have fixed costs. So fixed costs, I know you're just thinking fixed costs, they don't change. Like depreciation is a fixed cost, it doesn't change. But you could always have other overhead things. So fixed costs could change, but you generally just, like we did for job order costing, come up with an estimated amount of overhead and apply that. It's kind of the same thing what we're doing here. So generally what we think our fixed costs are going to be. This is really a planning tool. This tool is a planning tool, and just to help you assess your contribution margin, which I'll get to in a second, because the sooner, the bigger you can make your contribution margin, the sooner you get to profitability. So fixed costs remain the same in total. So in general, we say on average our generally overhead costs run, I don't know, $2,000 a month for Mrs. B's Apple Cakes. Okay, so that's not to say that, oh yeah, the stove broke down and this month it was actually $2,200, and last month it was really great, we had, we didn't have anything extra, it was $1,800, but on average we run $2,000. Okay, so don't get like fixed or not like set in stone fixed, right? But fixed are the costs that you have to incur before you can make one cake. So it's the rent I have to pay on the commercial kitchen, or it's the depreciation on the commercial stove I bought. It's the property taxes, it's the utilities, it's the plant supervisor, it's the maintenance people, it's the janitorial people. So all of those costs are part of my fixed costs because they're not directly tied to the product. Okay, so insurance, rent, so on. All right, so we have break even. So here's our fixed cost line. On average, we run $2,000 a month, and then so until I get to this point, all I'm doing is recouping my fixed cost. But once I get to the next cake, right? So well, let's just figure it out, right? So if I have $2,000, right, and divided by $10 a cake, so that means I need to sell 200 cakes to break even. So this break even point right here is 200 cakes. So there's my volume, right? So So the 201st cake that I sell, I'm actually making a profit. So if I sell them for 25 and my cost is 10, that means $15 is my contribution margin. So sales minus variable cost is your contribution margin. I'll show you here that in a second. So therefore, when I sell that 201st cake, I'm actually making $15 of profit. Woohoo! Gonna go take myself to lunch. So this is break even, right? So this is my variable cost and this is my fixed cost. And then at the point where my variable and my fixed cost intersect, this is a loss, and then the very next unit is a profit. Okay? So I have to recoup all my fixed costs before I can start making a profit. So here's some underlying assumptions, right? Both costs and revenues are linear throughout the relevant range. Well, let's talk about relevant range. What is that? So that just says, what is my maximum capacity? So if I rent out this commercial kitchen and it has, and my capacity based on everything is 100 cakes a month, that's my relevant range. But you know what? Everybody loves my cakes, and so maybe I put in another stove and change things, and now I have a new relevant range. And why is that important? Because now if all of a sudden, if I can start making 200 cakes a month, then maybe I can start buying in bulk, and I can get better pricing on my flour, sugar, eggs, and so on. And so maybe my variable costs might go down, right? And my profitability might go up and increase my contribution margin. So relevant range is really important. So basically that's the maximum capacity of your current situation, right? And when you change it, add another shift, add another stove, reduce a shift, reduce a stove, you need to do these analysis all over again because your relevant range has changed. So all costs can be classified as fixed and variable. Changes in activity are the only thing that affects a factor. So we're not worried about product mix. So we're not going to worry about sales mix, and we're assuming that all units produced are sold. So that's just our underlying assumptions. And then we talked about contribution margin. So contribution margin is selling cost minus, or selling price minus variable cost. So in this case, we have a unit, something that's $500, subtracting out the variable cost of $300, leaving us a contribution margin of $200 a unit. And then we take that $200 a unit into fixed cost to figure out how many units we need to break even. So I go into much more detail on my videos, so I don't want to belabor that. And then we have the CVP income statement. So, so we have it, and that's the other thing. If you can get your problem down to per unit, 1 unit, so 1 unit of Oscar Bear, these are teddy bears, sells for $21, cost me 14, so my contribution margin is 7. So if you can get down to 1 unit, you can solve the problem. A lot of times when you're dealing with these gross numbers, you don't have number of units, you don't have all the information that you need to solve the problem. So always try and get it down to 1 unit. So cost per unit minus, or sales price per unit minus variable cost equals contribution margin. Okay? Again, watch my videos. And then we're going to move on to process costing. So process costing is about mass production. So no customization here, right? So we're making a whole lot of one thing. And so be sure and look at my Oreo video about process costing. Like, do I remember right? They make like 400,000 cookies a day? Or was it 120,000? Anyway, a lot of cookies. I've always wanted to sculpt on the cream inside, but I've never been brave enough. That's impressive. So, all right. So be sure and watch my process costing video. And then, so the last week we looked at job order costing, and the challenge was overhead. How do we allocate overhead? This week, the challenge with process costing is coming up with equivalent units of production. So it's a little kind of a bizarre little concept, but this is how we roll, right? So equivalent units of production is saying, let's look at ending inventory. So the whole problem is we got to figure out how much everything costs per unit, right? And then so we have to deal with this ending inventory business. And again, watch my videos. I go into a lot more detail, but I'm just going to explain equivalent units of production here, and then I'm going to let you go. So here we have the end of the day, and the whistle blows, and you've got these 3 planks not finished, and you're like, boss, just let me stay. No, we're not being overtime. You got to go home. So now I have to figure out how many of these partially finished units I have that can make up a whole unit, right? So I like to call them pretend units. So I'm going to say these are a third done. So these 3 boards I would say are a third done. So I would have an equivalent unit of 1. So I would have 1, 2, 3, 4, 5, 6 units, 6 boards completely done, right? And then I could start calculating my cost per unit, apply that to what got processed and transferred out, and then I can then value my ending work in process inventory to figure out how much that should cost. So that's why I need equivalent units of production. Again, watch my videos. I think you'll find them very helpful. And let's see. Well, there you go. So anyway, I just want to kind of introduce things. Hope things are going well for you. Reach out if I can help you. And I'll see you in the classroom.